Crude is up almost 5%, so we're just shy of $95. The major averages are lower, as we said, led by the NASDAQ today, and we'll get much more into that. We've talked, Josh, yesterday that this really isn't all that complicated. We have no real sense about where this conflict is going, and in the time being, it is the bottom read on your screen. Oil's green, stocks red, plain and simple. And we'll just go with that until something changes.
Yeah, and I think the thing to keep in mind is that the vast majority of market participants are not actively playing this game where the market closes at 4 p.m. They try to guess whether or not tomorrow is a green oil, red stocks day, and then position themselves accordingly. Most people are just riding this out. And if you're active, what you're probably trying to do is fade overreactions in oil versus let me try to be the person that figures out the exact moment this conflict either improves or gets worse. It's a game that nobody can really play with a straight face and tell you that they have any sort of edge, because of course they don't. So you have to decide what you're doing in the market, what type of participant you are, what you're expecting to get out of this. I think it's perfectly okay for us to chop around, not make a lot of progress right now. We're digesting 3 years of above average S&P 500 returns. And if we have to go a quarter, 2 quarters, 3 quarters without much to show for all this volatility, truthfully, it all comes out in the wash. It's not the end of the world. If you are looking to do something that is a little bit more proactive, what you're probably doing is sticking to the stocks that are working at the moment. And those include energy, oil stocks. Valero still looks great, all of the refiners. But again, that's a fairly narrow lane. Most stocks are just chopping.
Hard to really have some high level of conviction anywhere as long as we remain in this sort of murky, foggy area, right, Malcolm?
Yes, but I think 4 weeks ago, when this whole thing first started, we could make the case that it's probably going to be short-lived. It's probably going to be a blip on this quarter's earnings reports. It's probably going to be a thing where it's a temporary shock to the system. I think as we go into now, earnings season rolls over into next week. We have CEOs presumably telling us that they can't quite forecast what their transportation costs are going to look like, what their energy costs are going to look like. The guidance that they give is going to be less sure than it would have been had this conflict been over before March was over. And so I think that we have to consider that negative sentiment and the weight that it could have on investors coming into earnings.
I think it's a great point. Right, the numbers are still expected to be good.
Yep.
Earnings expectations and estimates, even moving forward for the quarters ahead, are still good. Malcolm raises a good question, though. What happens if the narrative starts to deteriorate? How much say will that have into how the market trades?
Yeah, so I think CEOs are going to be somewhat guided. I mean, it's a legitimate point, right? Once the war's over, what is the short, intermediate, forget longer term, because I don't see longer term damage from this. What's that going to do to their input costs? Oil specifically. Here it talks about not going online for 2 to 3 months, getting back to where we were. Those are input costs that affect nearly everything you're wearing today, everything on this desk. So what's that do to inflation? But you know,
this is real material. I mean, you speak for your sport coat might be made with a crude oil alternative, but just speak for yourself when you're talking about wardrobes on this show.
Sorry.
I digress. Please continue.
Just
didn't want you to soil anybody else's reputation up here when you should be singularly focused on your own wardrobe. Please go ahead.
So that's part of the issue. But then, you know, we're so consumed, justifiably so, by Iran. What we're not focusing on, even though it's in the headlines, is what's the damage to private credit. Every day, and that's euphemistically, we see gates going up and limiting withdrawals. These are long-term contracts they have, the loans, so there's an inability to pull that out. What's that do to confidence, though? And then when you get to what was, we'll see at least 1 cut this year, maybe 2. Are those completely off the table? So there's a lot to navigate here, and that's why I'm being very, very selective. We'll talk about it later in terms of what I'm doing. Basically staying pat. I raised some cash earlier on. I mentioned Taiwan Semi got too big. It's still arguably too big, but took some cash there. Other areas where I would have liked to have taken cash, I didn't, but it's not off the table.
Okay, so Rob, UBS today tries to lay out their best in what sounds like their worst case scenarios, in which they say a rapid resolution should see the S&P bottom soon and rise towards 7150 by year end. if disruption persists until end of April, we see the index potentially falling towards 6,000, which, you know, I think others have opined about that number too. A more prolonged shock could push the S&P towards 5350. That would be an attitude adjustment if that happened for a lot of people who've been positive on this market for many of the reasons that Malcolm said, because they've been trying to look past all this. You get down to 5350 or even in the neighborhood, it's going to feel like a neighborhood you no longer want to live in.
You know, I think the market has had support recently, and that's been indicated in flows, which have been positive towards equities for quite some time. We're only off 5%. I think it's markets are trying to wrestle with the fact that there might be this pivot, right? And that pivot from the president, it has protected markets. So you can't be Pollyanna about what the duration of the impact could do to a lot of businesses. I think you have to pay attention to it. But the reality of it is you have to put yourself in three buckets. Are you looking to put cash to work? Do you need cash? Do you want to rebalance? The one thing I can tell you across all those is they may be different answers, right? And so if you're in the put cash to work category, I think you probably want to undulate the accelerator because the risks certainly appear to be significant. If you're in the raise cash mode, I think maybe you take advantage of that selectively in the areas that have held up. Let's know, though, that fundamentals are being restored absent this shock. Forward PE is now 19.7. The 10-year average is 19. The PEG ratio, PE to growth, because growth's exceptional, the 10-year average is 1.6. We're at 1.2. So we are trading at a discount on a PE to growth basis. So there's some fundamental restoration that has happened. You can't ignore the risk, but there has been fundamental restoration. There is limited complacency outside the price of equities. There's a lot of worry in sentiment, for sure, but around private credit, around Iran. But the reality of it is markets are behaving like they want to believe. And if they're given a reason to believe, we're going to be okay.
I know, but I feel if there's complacency anywhere, it's in the belief that this is going to be short-lived, not broad, and not more messy. Because we may not have full control over the answer to that question. As you know, as the days progress, we may find out that we don't necessarily have the only say in that question. And there may be a level of complacency around this idea, oh, this is not going to last all that long. It's not going to have a tremendous hit towards earnings. This too shall pass, which is why Barclays today and their macro desk is out with a note that says the wall of worry is worth climbing. Thinking that, okay, we're all worried about what's happening over there, but fundamentals, earnings, AI investment are stronger than where sentiment currently implies it to be.
And that is the great point. We have been saved again and again by rising earnings estimates, which continue to happen. So that is happening. Companies are telling you that their plans are to continue to spend.
Right, but is that breeding more complacency? Because we just assume that it's a given.
There's no doubt because it's evident in the price. You think with the news that we've had, we shouldn't be down a little more?
No, but we're not because we're afraid of what you said at the top. We're afraid of the Trump put. Like we saw.
I don't know why we're afraid of it.
No, you know what I'm saying. I'm saying you're afraid to get too negative.
Correct.
Because it's always lurking out there. That's the whole point.
You know, I'm going to challenge the narrative that, you know, that we're complacent and that the market's only down 5%. Well, that's true if you're an index investor. But depending upon where you are in the market, you're not complacent, you're worried. You're looking at Microsoft, you're looking at Meta. You look at the Mag 7 overall. Okay. Then you go and you look at some industrials. Then you go and you look at the banks.
But wouldn't that have us down more than 5% then?
That's my point.
We're down 6.7% from the high. But to Steve's point, there are absolute wipeouts in almost every sector. Maybe the only sectors that you can't find a lot of wipeouts right now are utilities.
But energy.
But like even industrials have, of the 11 sectors, taking utilities out, Industrials have the most stocks that are still up on the year,
Yep.
right? You could find industrials, look at the home builders, those are considered industrials, that are down 35%. Look at retail names. Gasoline, so this is via AAA. The national average price at the pump is now $3.98.
Yeah, it's almost $4.
National, right?
Yeah.
So some places much higher, especially the places where a lot of people live.
Diesel's like 7 in California at least.
Yeah.
Now
California is always
approaching,
super high. And
sure.
It's ridiculous.
Okay,
that
but so
plays into the kind of input
Right,
costs
can we
that,
agree-
that
But it's not
Malcolm's
the
talking
absolute.
about.
But it's not the absolute level, though.
Can we
It's the
agree, though,
rise.
that
It went
oil
from
between $80 and $100 a barrel for longer takes away the profit margins of a company.
we
like
know it does.
So that's the part that I think is breeding complacency. We're looking at what's happening right now, and we're saying there's talks about talks happening, and we trust that that's going to materialize into something positive. But what if it doesn't? Or at least, what if it doesn't for the next quarter? What does that do to the margins of the discretionary sector? Halo means heavy assets, low obsolescence, right? Means probably that they rely on fossil fuels. So I have jets that have to fly, but I have to consider what does it cost to fuel those jets? I have trucks that move things from place to place across the all of that has to be taken into account.
And the
being complacent.
and the consumer. So when gasoline goes from 3 to 4, lightning fast, which is what just happened, you see the result. You see what they do to the Starbucks, to the McDonald's, to those names. Those are the DoorDash, annihilated. Those are the fastest things that people cut back on because, not because they want to, they literally have no choice. And we haven't been in an environment like this for years.